Well, good morning, everyone, and thank you so much for joining us this morning for the December FOMC meeting recap. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with the presenters today by using the chat feature found in the bottom of your screen. You can find that chat feature by clicking on those three dots on the bottom of your screen if you're on your mobile device, or by selecting chat if you're joining from a desktop computer. Before we begin, I'd like to introduce you to our economist on the call today, David Widmar, co-founder and managing partner of Agricultural Economic Insights. David was kind enough to glean the information from the meeting yesterday, interpret the data for us, and share his perspective on what yesterday's findings will mean for the overall economy and at the farm gate. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you all so much for joining us. This meeting is going to be recorded and shared with all registered guests following the webinar, so you can revisit the slides and kind of go through the content once again. So with that, David, I'll turn it over to you. Thanks for joining us.
Well, thank you, Micah, for that introduction and for organizing today's event. And thank you all for taking time out of your pre-holiday schedules to think about this a little bit. One thing about it, 2024 is going to go out with somewhat of a bang, as there's been a lot of sort of things being announced and figured out and plotted out and trying to chart a path forward into 2025. And the Fed is no exception to that. They revealed their latest rate cut, a 25 basis cut. You've heard a lot about that. But once a quarter, they also summarize their economic projections, and that's a really helpful, I think, map or guidance for where they're going to maybe be watching for the economy in 2025, so we can keep an eye on that. And that's what we're going to do today. We're going to break out that summary of economic projections, and we're going to talk through the changes and what it might mean for the broader economy, but also for the decisions you have to make on your own farm. First thing I want to talk about with this summary of economic projections, their track record here is not perfect. So don't view this as a crystal ball. Use it as a kind of a rubric to say, this is the decisions they were making, this is the expectations they had, and if we deviate from those expectations, we could start to see the Fed moving one way or the other. So again, it's a little bit of a map or some guidance that we can use to think about, if this, then that, right? So if things play out sort of as the Fed thought, then this is probably how what we're sharing here is probably going to be what they move forward. But if we see inflation getting higher, or if we see unemployment creeping up, so there's this trade-off here, and we can kind of plot the course here. So what I want to do here is walk through some of these tables here and help you think through what happened. One of the key takeaways here is the Fed, for most of the summer, was worried about downside risk to the economy. I think now they're starting to signal they're worried about upside risk. So to put this in a little different context, downside risk would mean we're worried about the economy slowing down too much. We're worried about unemployment levels creeping up too high. We're worried about a low GDP measure. The upside risk here now is maybe we have inflation creeping back into the system. Maybe we have a strong economy, and that we might need to, keep a little bit of braking on the U.S. economy to keep us slowing down just a little bit. And so I think for most of 2024, there was this concern about slowing down. That a lot of conversations about recession here in 2024 that hasn't materialized. And now we're seeing this conversation shift to, okay, how do we make sure that we apply enough braking heading into 2025? So let's talk about what was happening here with specifically GDP. Again, this is inflation-adjusted GDP. These aren't perfect measures. This will change as the final tallies get counted as everybody finishes up their Christmas shopping. But back in September, they were thinking that the U.S. economy in 2024 would have about a 2% inflation-adjusted GDP growth. And then we see a revision here in December of saying now the economy is probably growing closer to 2.5%. And again, is this shift, it's not, again, the final measure, we'll see a different final number, but this idea, this trend of a little bit hotter economy than what we thought just 3 months ago, that's a big underpin for what we see with, the Fed having fewer expectations for rate cuts heading into 2025 and beyond. Unemployment, September projection for 2024 unemployment was 4.4%. This came in a little bit lower at 4.2%. And again, that unemployment rate at or below September expectations is consistent throughout 2025 and 2026. The other one I want to point out here is PCE inflation. Again, there's several inflation measures. I'm going to focus on that top line PCE. 2.3% were expectations 3 months ago, back in September. 2.4% today, but take a look at 2025. That's where they've really sort of signaled some additional concerns. 2.1% a few months ago, now looking at 2.5%. I have some more charts to look at that. That's a big improvement, but it's this combination of GDP a little higher than what they were expecting, and also inflation a little bit higher than they were expecting, which is why we see the Fed sort of worried about this upside risk here in the economy moving into 2024. So let's talk about this Fed funds rate expectation. This is the median. I'll show you the dot plot of all the participants' expectations here in a bit, but September the projection was 4.4%, December 4.4%. They've got it to where they were wanting to go there. But again, look at 2025 median expectation. Median is the middle of the road. A year, excuse me, 3 months ago in September, we thought 3.4%. That would have been 4 additional rate cuts in 2025, so another 100 basis points. Now we see that cut down to 2, and then again, the possibility for 2 additional rate cuts in 2026. So this idea of slower or higher for longer, the Fed's going to be moving slower heading into 2025 than they initially expected. And I think, again, it's all this uncertainty about upside risk in the economy, strong GDP measures, stronger inflation. They're worried about this, so they're going to move a little bit slower to keep a little bit of braking in the economy. And we're going to talk about sort of this idea of this neutral rate here in a couple slides here, with this idea of they're still above this sort of neutral rate, so it's still pressuring. And the idea is they're moving towards that neutral. And if something bad happens in the economy, they can move below the neutral rate to stimulate the economy. So we were 100 basis points higher. We've closed that gap, so not as much braking, but it's still in this braking mode. So we'll see what it looks like when we get closer to that neutral level. Here's the dot plot. Again, each dot represents a member of the FOMC. These folks spend all their time thinking about the economy. A subset of them vote on the rate hike movements at these various meetings. And so, again, I think the takeaway here is to look at the range of expectations and some of the maybe disagreements or some of the uncertainty that is lingering out there. I try to summarize 2025. Sort of the median here gets you those 2 additional rate cuts, but as you can see, there's 4 participants that think we might come in above that median, and there's another group of participants, maybe about a handful here, 4, I guess, another 4 or 5, who think we might cut rates even farther here in 2025. The takeaway here is there's a big spread, and so that median of 2 cuts or 50 basis points is not quite enough of the story, and so we see about 150 basis points of range. And again, if something surprise happens, that range could be even wider. So this is sort of the best case scenario, I think, is that we see these 2 cuts, and even within the expectations of where we are today, all the information we know today, there could be a range of different outcomes that are still anticipated. I think this is what makes it really hard. If you're trying to hold off on a piece of equipment purchase or refinancing or some financing decision based on a Fed decision that could or could not be coming, there's a couple things I want to point out here in today's webinar that makes it really hard to forecast and predict and try to outsmart the Fed. And this is definitely one of them. You can definitely find a Federal Reserve economist who would confirm that your bias, if your bias is, I don't think we're going to see many rate cuts next year, or I think we're going to see a lot of rate cuts, you can talk to one of those FOMC participants and you're going to hear there are different concerns. But if you look at all of them together, there's a wide range of expectations. The other thing I want to point out here, and I should have mentioned this earlier, but look how much wide the range is for 2026, 2027, and the ambiguous long run that we never really get there, but that's a really important idea to help us think about that neutral rate and where we might be trending towards over the long haul, pending excluding any sort of surprise or deviation or shock or giant recession in the economy, and that's why we never get to the long run. Something always disrupts us. But what I want to point out here is look how wide this range is for 2026. Again, it's more than 150 basis points, a similar range of expectations in 2027 and also in the long run. And I think the idea here is we're probably trending still lower, but there's this upside risk for interest rates, and there's also this neutral level that's probably somewhere around 3%. In fact, the Fed here in this earlier slide, I should have pointed that out, this long run Fed funds expectation is around 3%. Now, I was looking at this in several of the last December projections that they put out going all the way back to 2018, and usually that's around 2.5%. In fact, 2.5% is where we would have saw this a year ago and in the previous update. So we've seen this creep higher about where this sort of neutral level is. It's coming in at 3%. And we'll talk about why that's important here. This is the Fed funds effective rate. I put it all the way back to 2000. There's going to be another click lower here with this latest decision, but I want to point out this 3% here. That's that area where the Fed's thinking we're going to get there in the long run. And as you saw the expectation, there's a few participants who think we'll get below it, but 3% is the median. And the idea that I want to point out here is there's not a whole lot of additional room, maybe as the Fed thinks about lowering this in, we're not going to see a huge range of changes, again, unless there's a big surprise, unless there's a big shock. But the idea here I want to reemphasize is that we were below that 3% for almost more than a decade, 12, 13 years. And so our recent memory around interest rates are at much lower Fed funds levels. And the Fed funds, they're signaling now we're going to be approaching this 3%. That's sort of that landing spot that they're targeting, that they're trying to get us towards in the long run. And it's just a higher level than what we've seen over the last 10 or 12 years. And so I think that's going to be really important. Thinking about expectations and where are your own interest rate expectations anchored to. I think it's important to start thinking about, okay, a Fed funds rate at about 3%. If we see rates above 3%, they're sort of breaking on the economy. If we're below 3%, they're trying to stimulate the economy. And they're signaling this 3% is that neutral level. It's a little higher than in that 2.5% we would have been thinking about a year ago or even earlier, but it's also considerably higher than what we've seen in the last 10 or 15 years. I want to spend a little time talking about inflation. The Fed signaled a little bit higher expectations for inflation here in 2024, but also into 2025. On the left, this is the monthly data. It's a year-over-year measure of that PCE index. And as you can see, we've made a lot of improvement here in 2024. Again, it wasn't that long ago we were seeing those monthly year-over-year measures approaching and even exceeding 7%. On the right, I put the table here for those of you who really want to look at the specific observations. And then I averaged up the annual activity. So 2022, we hit 6.6%. We fell to 3.8% in 2023. And then I think we're going to see this 2024 number coming in at 2.5% or maybe a little bit lower as we get the final measures put together. But look where we started. That's this year-over-year measure was 2.6% and got as low as 2.1%. So we made quite a bit of progress. We saw that blip higher at 2.8 and 2.7. But again, we're approaching 2%. But I think this last squeeze from 2.5% inflation to 2% inflation, that could be a heavy lift for the Fed to try to get that taken care of. And as they're signaling, that's why they're not as aggressive about lowering interest rates into 2025, is they want to keep the brake in place to make sure we try to get that down close to that 2% level and it's maintained there. There's a little bit of bouncing around here. I think it's important to keep in mind is we don't want to just focus on 1 or 2 months of data points. We want to see sort of this trend that plays out and that it's not just a good month or a bad month in reading. You think about hurricanes that cause blips or used car prices or home prices. There's all sorts of short-term blips that come in the data, so we need to see multiple strings of that. One of the measures that I think is really valuable, and if you listen to Jay Powell's comments during the debrief that they shared, is some of the inflation measures they've been seeing most recently are causing them also a little bit of pause. So problem one is we're not back to 2% yet. That's that chart I just showed you. Problem two is some of these month-over-month measures are showing a little bit of concern. Because what we saw last year is we had really low inflation in the fourth quarter of last year. So we're starting to measure against those really low levels last quarter. And so that kind of hides those year-over-year measures that I just showed you. When you look at month over month, you can kind of get a better idea what the pace has been. Month over month doesn't always make the newspaper or the evening news because this is a hard measure to think about conceptually. What's a 0.5% month over month change? We like to think about things annually, but the idea here is just look at the trend here. And so we saw really low inflation back in that April May window, month over month basis, and then we've seen it stabilize throughout the summer, but we've seen this tick higher in the last parts of the fall. So the Fed's going to be carefully watching this. They would have liked to have seen this sort of level off. You can see these sort of fits and starts here. We had a little bit, this is whenever inflation was really high. We got it worked lower, and then it crept back up in early 2023. We kept trending lower, and then it crept back up in early 2024. So again, I think the Fed is not surprised to see this uptick. We've seen other upticks, but this is, again, signaling why there's a little bit of pause here in those 2025 plans to cut rates further. One of the points here, I know we've talked about this in other updates, but I want to just keep emphasizing this is, are we saying goodbye to the yield curve inversion? A lot of times we see an inverted yield curve, and the conversation talks about a looming recession. But ultimately, for us borrowers, it means that long dated money is, equal to or cheaper than short dated money. And there are implications for our business and maybe the types of loans that we want to pursue or the type of loan structures that we're thinking about. And so 10-year treasuries here are in blue and 1-year treasuries are in red. And so we had this inverted yield curve for the last several years. And this really took off when the Fed started raising short-term rates. And so what happened is the Fed was raising short-term rates, and those nearby markets, those short-term loans really shot higher, like your operating lines of credit. But those long-term loans, like maybe your home mortgage or your land mortgage, or maybe some equipment mortgage, those were a little more sticky. So they didn't raise as fast as those short-dated loans did. And what we saw here is we saw this gap unfold, and now we see this gap closing. Well, how's this gap closing? Well, the Fed started cutting rates in 2024, and you can kind of see this 100 basis points a cut fall through here. But look what happened with these longer 10-year treasuries. We didn't see much of a response here. So short-term rates fell, long-term rates were stubborn, and that could continue to be the story here is we would expect this yield curve to uninvert itself, and we're getting close to doing that. We're about even today. But even if the Fed keeps cutting rates, we could still see this long-term yield curve stay stubborn. And in fact, the long-term interest rates could drift slowly higher. So always be keeping an eye on, the Fed decisions. That's always gets a lot of attention, but keep an eye on those longer interest rates. So machinery, again, farmland, those are two important things for agriculture. Keep an eye on those. There's not going to be quite a lockstep as we see moving forward. Let's talk a little about the timeline that the Fed's been working on here in the first half of 2025. They're going to have another meeting in January. Towards the end of the month, they have a meeting in the middle of the month of March, and they're going to get another update of the summary expectations. And that's going to be important because it's going to start to fill in some of the details of how did 2024 end and what's the first few months of 2025 starting to look like. As we move into the spring, we're going to have a meeting in May and then another update in June with the expectations. And I look forward to joining you in those March and June to sort of summarize an update of those expectations. So I'm going to wrap it up here. And as you probably know, there's a lot of topics here we could have covered, and I didn't have a chance to get through all of them. So I look forward to answering all your questions here as they come up after I wrap this up. The first thing here is that 2024, I think we just have to stop a second and look back and say, yes, we did make some considerable progress on inflation. Inflation continued to go back into that lamp. The genie was out of the bottle. It's getting back into the bottle. It's not completely there, but a lot of progress was made, and we saw 100 basis points of rate cuts on that Fed funds rate. So that's kind of the summary, and the economy is ending pretty strong. So I think as far as grading the Fed for their progress in 2024, they did a pretty good job here in 2024. Things went really well for them. 2025, more uncertainty has been signaled. They're going to move slower with these rate cuts. They see maybe some inflation concerns, and I think they're worried about some upside risk to the economy here with maybe some overheating or heating coming back in. One thing I want to mention here that kind of came up in a few pieces is the idea of tariffs and see-through inflation. So a tariff, of course, if the U.S. imposes tariffs, that's going to raise prices of goods that we import. Agricultural has a few of those goods like vegetables, but also thinking about, steel or cars or technology that we might be importing. So if we have a self-imposed import on self-imposed tariff on imports, that could cause the prices that you see at the grocery store or at the online to increase. And so the Fed's starting to work through their playbook for something called see-through inflation. And this is something they worked on during the previous trade war, and this idea of, okay, if we see the US impose tariffs, the PCE, the CPI is going to tick higher because of this price increase at the consumer level. The idea that the Fed has to really think about is how much of that is, because of the hot economy, or how much of that's because of the tariffs, and that tariff sort of has a short-term blip. And so they're going to have to think about see-through inflation. And the idea of see-through is we want to make sure we see through that data, that short-term data tick up, make sure we're making good policy decisions based on, what's causing the inflation. If it's tariffs, it's probably going to work its way through the system, and we're going to see that uptick and then a flattening of the prices. It's not going to be a continued trend. So I think the Fed's job is going to get a little bit harder heading into 2025 because of a lot of reasons, but see-through inflation and the threat of tariffs will make that data a little bit harder to interpret. Last 2 points, I think long-term rates have proven to be stubborn over 2024, and I think that could continue into 2025 as well, especially if this yield curve keeps uninverting and the Fed is not, aggressively lowering those short-term rates. I think short-term rates, they come down a lot, but we're starting to approach that 3% long-term expectation. So the idea here is, assuming the economy stays healthy, 3% is kind of about the speed limit. That's probably about as low as we're going to see it. If we see the Fed, the only way we're going to see the Fed really drop that is a very different outlook for the U.S. economy, much more of a recession concern, or probably evidence of a recession to make that happen. So Micah, that's what I have here for prepared slides and comments, and I'm happy, as I talked about, to answer whatever questions came up along the way, because there's a lot of things going on there.
There are a lot of things. David, I've got a few that I want to just throw your way. The first one, a little bit longer, so stick with me here. Flat yield curve right now. Fed has 3 rate cuts, yet the treasuries have been signaling higher long-term rates for about 60 days. Government spending is not necessarily slowing. Is the Fed making a mistake by lowering interest rates and even hinting at further rate cuts, in your opinion?
So I think the facts there are were definitely spot on. I think if you looked at those 10-year treasuries over the last 60 days, they're up about 80 basis points. So there was a lot of bouncing around in there, but the trend over the last 60 days has been higher. The Fed has, I think one thing to keep in mind from the Jay Powell era of the Federal Reserve is they seem to be slow but deliberate in their actions. And so we were criticizing them a couple of years ago for not raising interest rates when inflation was in the data and they weren't moving fast enough. But when they moved, they then deliberately moved for 6 or 8 months of a lot of interest rate hikes, excuse me, a lot of interest rate hikes. And now we see a situation where in 2024, again, the argument was they're not lowering interest rates fast enough, and so they're not lowering fast enough. But then when they came out, they had 4 cuts, and I think it's played out so far well for them. So the question is the Fed making a mistake here? And I think the answer is, I think they've shifted their tone. I think the market's picked up on that. They have a meeting in January. They're having another meeting in March with new projections and expectations. But I think, again, they're going to move slow but deliberate. And so they're going to want to see, inflation kick up significantly, or not significantly, for multiple months. They want to see a string of data really coming together before they're going to act and move in that direction. So I think if you use the slow but deliberate approach to how the Fed's been navigating this, I think that fits in a little bit better with how that's a good mental model, and it fits that narrative or that idea that they've stepped back from, thinking about another 100 basis points in 2025. They've cut that back to 50. So we'll see how that plays out. I've shared a lot about what are the cases for short-term of rates being lower, and what are the arguments for rates being higher over the long term? And I do think that the federal spending is going to be um, a bit of a sore spot because, I think we're going to see a lot of attention on what's the spending looking like, and that's both tax cuts and expenditures. Uh, things that we're spending money on both in payments but also in revenues. And I think that that's going to be a point of contention or a point of focus here in the next several years. And I do think that the Fed's going to find themselves in a spot where if we see a lot of deficit spending, it's probably going to look inflationary in the data, and they might have to move to offset some of that. Great question.
As we look at the stock market, it did a little bit of a retreat this week. And when the quarter point was kind of both expected and wanted, why do you think that was?
Well, let's step back for just a second and think about where asset values have gone. We might not have seen in farmland this year, but if you look at S&P and you look at some of these other asset classes, there's been a huge rally. The stock market's going to have a phenomenal year this year. They had a phenomenal year the year before. Um, and some of this, of course, is these expectations of lower interest rates. And so I think any setback we've seen in the last few weeks is not really, we don't want to overshadow sort of this 51 weeks of activity. It's been a really strong year. And I mention that because we really only have measures for price inflation, but there's another type of inflation, it's asset inflation. So if you're really concerned about inflation and inflation rearing its ugly head in the future, you would look to asset prices to help think about, do we still have a lot of enthusiasm in the marketplace? And so the stock market is, I think, one of those areas where really strong performance is that a signal of maybe some overheating coming down the road. The second piece here is why the stock market step back this week. I do think there's a little bit of a, you know, so the idea here is the economy is performing a little strong. So the Fed was pulling back on the interest rate cuts, and so I think part of it was this kind of this narrative of, strong economy means higher interest rates, and we were really hoping for lower interest rates in 2025. We might not get there, so I think that was a little bit of that disappointment. But on the other side, it does mean the economy was doing is doing well. We didn't have that recession here in 2024. I guess I always kind of struggle with this. If you really want low interest rates, a recession is sort of the fastest way to get super low interest rates. And if you want a really strong economy, you're probably going to have a little bit higher interest rates. So there's kind of this back and forth. There's not really a silver bullet that everybody can hope for. There's always trade-offs that play out there.
The next question that came in was, will discounted rates, will discounted rate cuts actually be realized in local lending markets, or is this just an attempt to kind of restore market confidence in the U.S. economy?
Yeah, I think that's been one of the challenges is that, it's that yield curve that I talked about earlier, and those 10-year treasuries trending mostly sideways throughout 2024. Some bouncing around, but those short-term rates came down. Long-term rates really haven't adjusted. I think that's one of the challenges is we haven't seen enough movement to make a significant change at the farm level. So at the farm level, you're probably seeing operating lines of credit coming down a little bit, but then also those longer term rates are also a bit challenging because they've just been a little bit sticky. So I think that the reality here, going back to that chart that I showed you about the Fed funds rates and that 3% sort of neutral, we are not going back to that 2009 to 2021 or 2022 era of both low rates but stable rates year over year. So we're probably going to be in a higher interest rate. So while the outlook is maybe some rate cuts in 2025, a couple of them, it's still going to be a higher interest rate environment than what we had in the earlier decade.
So if you have a mortgage right now, 3%, you probably are stuck with that one, aren't you?
You're probably, and there's talks about that's some of the headwinds for the housing market is people have locked themselves into really low interest rates, and so to move, you're going to have to, if you wanted to upgrade houses, you're going to have a bigger payment because you're buying a bigger house. But also, you're going to be in a different interest rate environment. So, yes, that is a real challenge if we've locked in those rates. And if you're locked in, you're locked in.
This I have one just last one to close us out here. Um, is this economy really as strong as what the economic reports show, in your opinion? What is the likelihood we'll see inflationary pressure without economic growth? And if so, what are those impacts for the farm gate?
I do think there are areas in the economy that are doing better than others. I think there's always, the challenge here with any of these measures is that they are across 130 million Americans. And so it's an average across a large geographic area. And so you could definitely be in an area or a segment that's been struggling. So we always got to overcome that backyard bias. Um, but I do think the economy has been surprisingly well. It's beat all the forecasts that we would have had a year ago. It's actually outperforming a lot of our peers on relative to other countries to a global measure. So the U.S. economy has been fairly strong. I think some of that is how quickly we responded and how, again, it was slow, but it was slow and deliberate. So I said quickly, but I rather meant is the Fed responded in a big way to stem off inflation. So I think that was a big part of that. Mike, you get to remind me the second two parts of that question. I lost my
What does that
thread
actually
there.
mean for the farm gate if that is the case?
Yeah, so I think the next piece of that is one of the challenges for the farm economy has been a stronger dollar, and so I always cringe when I hear stronger weak dollar. But there are always a macroeconomic concern that creeps up like inflation, but there are all these other measures, and so inflation has been was a concern 2 years ago. High interest rates were the concern in 2023 and into 2024. I think the question is still out for 2025, but one of the ways the U.S. economy has been able to do well is we fought inflation, we got it under control, we had some of these higher interest rates, we had a strong dollar. That's been a bit of a headwind for some ag commodities. And I think the reality is that if we continue to see inflationary concerns and the Fed continues to pursue it with high interest rates, um, I still think some of the concerns there could be around asset values and how are we going to see an adjustment with respect to maybe farmland values at the farm level. We still see farmland trading at a pretty low capitalization rate. And so what kind of return are you willing to accept for farmland when we're thinking about a much higher interest rate environment, maybe some improvement, but still a higher rate environment than where we were just a few years ago. I don't think the farmland market has quite adjusted to that. So we'll see where the Fed is. One of the lessons that we had from the 70s is, and we did a deep dive on this in Escaping 1980, is that there was this inflationary battle that was unfolding in the 70s. And the idea is that inflation can be hard to encourage. We were trying to encourage inflation between 2008 and 2020, and now it's out of the bag. And we struggled in the 70s of getting inflation back into the bag. So can the Fed close that gap from 2.5% around today? Can we get it back to 2% and sustain it there? I think that last 50 basis points is going to be the hardest stretch. So that's what we need to keep an eye on for 2025. If we don't see them make continued progress, the long-term inflation concerns are going to start to come back in full swing.
Well, thank you, David. I appreciate your perspective. The last thing I wanted to share is that y'all just finished up my favorite article of the year, and that's your 2025 risk, if you will, 3 risks for agriculture in 2025. And so a lot of the things that you talked about in that article will maybe come into play. And so I wanted to highlight that for the listeners on the call. If you haven't had the opportunity to go to AEI.ag and read that article, I would highly encourage you to do such and reach out to your financial officer or Farm Credit Mid-America contact if you'd like to talk more about those. But at a high level, your top 3 risks were trade implosion, asset prices, and ad hoc or bust. And so I think all three of those things are going to be influencing rates into 2025 as we look ahead. So if you are interested in that article, like I said, feel free to reach out or go to aei.ag to find that article. And with that, we hope you all have an absolute Merry Christmas and a Happy New Year, and we'll catch you after the first year. David, did you have one last thing?
I was going to say, I think the best part about that three risk exercise is the framework. And I hope folks take that framework and they sit down and say, what are the three risks that I'm worried about in my specific operation? Those are three risks that we identified for the ag sector, but you're probably going to have a different list for your operation. And the idea is that make that list, summarize it, get input from your family members, but also those trusted advisors. So how can you turn concerns that maybe are keeping you awake at night, how can you start to use that as a starting point for building a plan to help addressing those and navigating those? So let's turn those risks into action items.
Well, thank you all so very much, and we'll see you after the first of the year.
Thank you.